The conversation around recessions usually sounds the same. Headlines get louder, uncertainty spreads, and suddenly every asset looks risky. Prices fall, confidence disappears, and the phrase, "buy the dip," starts floating around like it's some kind of universal solution. But that phrase alone doesn't help much when everything is dropping at the same time. Because here's the reality. Not everything that falls in price becomes a good deal. Some things fall because they are temporarily undervalued. Others fall because they were never strong to begin with. And during a recession, that difference becomes very clear, very fast. This is where most people get it wrong. There's an assumption that a downturn is like a clearance sale where everything is discounted equally. But that's not how markets work. A recession is more like a filter. Weak businesses get exposed, overhyped assets collapse. Debt-heavy companies struggle to survive. Meanwhile, strong assets get dragged down temporarily, even though their long-term value hasn't changed. That's why a shopping list matters. Not a random list. Not a reactive list. A pre-decided, prioritized list of assets that are worth buying when prices drop. Because when fear takes over the market, decision-making becomes emotional, and emotional decisions in financial markets tend to be expensive. So instead of reacting in the moment, the smarter move is to know ahead of time what actually deserves attention when everything goes on sale. Understanding the difference between cheap and valuable before diving into the actual list, it's important to clear up one idea that trips up a lot of investors. A low price does not automatically mean a good investment. During a recession, prices fall across the board, but the reasons behind those drops are not the same. Some companies see their stock prices decline simply because the overall market is down. Others drop because their business model is breaking under pressure. That's where the concept of zombie companies comes in. These are businesses that survive on borrowed money, weak earnings, or temporary hype. When the economy is growing, they manage to stay afloat. But when conditions tighten, they struggle to generate enough cash to sustain themselves. On the other side are quality assets. These are businesses and investments that continue to function even when conditions are difficult. They generate consistent cash flow. They provide essential goods or services. They have strong balance sheets and the ability to adapt. The difference between the two becomes obvious in a downturn. Essential sectors like healthcare, utilities, and consumer staples tend to remain stable because people still need those services regardless of economic conditions. Meanwhile, companies that depend heavily on growth, speculation, or cheap debt often face the most pressure. So the goal isn't to buy what dropped the most. The goal is to buy what still works when everything else stops working. How assets behave in a deep recession. To build a solid shopping list, it helps to understand how different types of assets behave when the economy contracts. Risk assets like stocks tend to fall sharply in the early stages of a recession. This happens because future earnings become uncertain, and investors start pricing in worst-case scenarios. Even strong companies get caught in the sell-off because fear spreads faster than logic. At the same time, safer assets like government bonds or cash equivalents become more attractive. Investors move money into areas that feel more stable, even if returns are lower. Commodities like gold often gain attention as a hedge against uncertainty and currency instability. Real estate can become volatile, especially when interest rates are high, but certain segments remain resilient due to consistent demand. And then there's liquidity. Cash becomes powerful during downturns, not because it grows, but because it creates options. When prices fall, those with available capital are in a position to act while others are forced to wait. Understanding this behavior is key because it explains why a recession shopping list isn't just about growth. It's about balance between opportunity and protection. The crash fund concept. Before getting into specific assets, there's one strategy that changes everything about how downturns are handled. It's called a crash fund. A crash fund is money set aside specifically for market downturns. It's not an emergency fund. It's not everyday savings. It's capital reserved for one purpose: taking advantage of falling prices. During a recession, opportunities appear quickly. Prices drop, sometimes aggressively, and those drops don't wait for perfect timing. Without a crash fund, the ability to act becomes limited. Cash or cash equivalents play a critical role here because they provide flexibility and immediate access when opportunities arise. The key is having a plan for how that money gets deployed. Not all at once, not based on panic, but in stages based on predefined conditions. This removes emotion from the process. And in volatile markets, removing emotion is often the difference between making a smart decision and making a costly one. The recession shopping list begins now. The focus shifts to what actually belongs on that list. Not everything, not random picks, a structured set of assets ranked based on reliability, recovery potential, and long-term value. Broad index funds. At the top of the list sit broad index funds. These represent the overall market, tracking large groups of companies rather than relying on individual picks. During a recession, index funds often drop along with the rest of the market. But that drop comes with an advantage. They automatically filter out weaker companies over time. Businesses that fail are replaced by stronger ones, which means the index evolves and improves without requiring constant adjustments. Historically, major downturns have shown a pattern. Markets fall sharply, then recover over time. Those recoveries tend to reward broad exposure rather than narrow bets. The reason is simple. Predicting which individual companies will thrive is difficult, especially during uncertain periods. But owning a wide slice of the market increases the chances of capturing that recovery. That's why index funds often serve as the foundation of a recession shopping list. They combine simplicity with long-term growth potential. High-quality dividend stocks. Next on the list are high-quality dividend stocks. These are companies that not only generate profits, but also share those profits with investors through consistent payouts. During a recession, stock prices can drop, but dividends often continue. That creates a unique dynamic where income continues even while market values fluctuate. Companies in sectors like utilities, healthcare, and consumer goods tend to maintain their dividends because demand for their products remains steady. This makes dividend stocks particularly valuable during downturns. They provide a sense of stability and a source of income, which can be especially important when other investments are under pressure. But not all dividend stocks are equal. The focus stays on quality. Strong balance sheets, consistent earnings, and a history of maintaining payouts matter more than high yields alone. Because a high yield doesn't mean much if it disappears when conditions get tough. Real estate investment trusts, REITs. Real estate has always played a unique role in financial markets. Even during economic slowdowns, the need for housing, storage, and commercial space doesn't disappear. REITs offer a way to invest in real estate without directly owning property. They manage portfolios of income-generating assets and distribute a significant portion of that income to investors. During a recession, REITs often face pressure, especially when interest rates rise. Borrowing becomes more expensive, and property valuations can decline. But that's also where opportunity appears. Rental income tends to remain relatively stable, and over time, real estate values adjust. When REIT prices drop significantly, they can offer both income and long-term recovery potential. The key is focusing on well-managed REITs with strong portfolios rather than chasing high yields or speculative plays. Why valuations get absurd during crashes? One of the most important patterns in financial history is how extreme valuations can become during downturns. In major recessions, strong companies have traded at prices that didn't reflect their true value. Fear drives selling, and that selling often becomes indiscriminate. During the 2008 financial crisis, large established companies saw their valuations drop to levels that seemed unthinkable just a year earlier. In 2020, entire industries were priced as if they might not recover at all. These moments don't last forever, but they create rare opportunities. The challenge is that they don't feel like opportunities when they're happening. They feel like risk. They feel uncertain. They feel uncomfortable. That's why preparation matters. Because when valuations become attractive, hesitation can lead to missed chances. The risk of catching falling knives. As important as it is to recognize opportunities, it's just as important to understand the risks. One of the biggest mistakes during a downturn is trying to time the exact bottom. Prices can fall further than expected, and buying too early can lead to short-term losses. This is often referred to as catching a falling knife. Another risk comes from leverage. Borrowing money to invest can amplify gains, but it also amplifies losses. During a recession, when prices are volatile, leverage can quickly turn a manageable situation into a difficult one. There's also the psychological side. Watching investments decline, even temporarily, can create pressure to sell at the wrong time. That's why structure matters. A plan that spreads out investments over time reduces the impact of timing mistakes and keeps decisions grounded. Pre-deciding the plan. The strongest advantage during a recession isn't intelligence or timing, it's preparation. Pre-deciding what to buy, when to buy, and how much to invest removes uncertainty when it matters most. This can take the form of setting price targets, valuation ranges, or percentage drops that trigger investments. For example, instead of investing everything at once, capital can be deployed in stages as markets decline. This approach reduces risk and creates flexibility. Automation can also play a role. Regular investments into diversified assets, even during downturns, help maintain consistency. Because in volatile markets, consistency often outperforms reaction. The first part built the foundation. It separated hype from reality, showed why not everything on sale is worth buying, and laid out the beginning of a structured shopping list. Now the focus shifts deeper into the assets that complete that list, the ones that don't just grow wealth, but also protect it, stabilize it, and in some cases, quietly outperform when everything else struggles. Because a real recession strategy isn't built on a single type of asset, it's built on layers. Growth, income, protection, and optionality all working together. Gold and precious metals. Gold consistently stands out during recessions because it behaves differently from most financial assets. When inflation rises or confidence in currencies weakens, gold often holds value or gains strength. It doesn't rely on earnings or business performance, making it less vulnerable to economic shocks. Its value comes from scarcity and long-term trust. Silver and other metals can also play a role, though with more volatility. Rather than chasing growth, these assets act as protection, helping balance portfolios when uncertainty spreads across global markets. U.S. Treasury bonds and high-quality bonds. During uncertain times, investors naturally move towards safer assets, and U.S. Treasury bonds often lead that shift. Backed by the government, they offer stability and predictable returns even when markets fluctuate. High-quality corporate bonds provide slightly higher yields while maintaining relatively low risk due to strong issuer credibility. Together, they create a reliable income layer within a portfolio. In recessions, this stability becomes essential. Instead of chasing higher returns, the focus remains on preserving capital and maintaining consistency when other investments face volatility. Treasury inflation-protected securities. Tips. Inflation can quietly erode wealth during a downturn, which is where Treasury inflation-protected securities become valuable. These bonds are designed to adjust with inflation, increasing in value as living costs rise. This built-in mechanism helps maintain purchasing power over time. While they may not deliver high returns, their role is specific and important. They act as a safeguard when traditional fixed-income assets lose real value. In a balanced recession strategy, tips provide stability and help ensure that long-term wealth isn't diminished by rising prices. Cash and cash equivalents. Cash may seem unexciting, but during a recession, it becomes incredibly powerful. Its strength lies in flexibility rather than growth. When asset prices drop, having cash allows quick action without needing to sell investments at a loss. Cash equivalents, like money market funds or short-term treasury bills, offer similar liquidity with minimal risk. There's also a mental advantage, as holding cash reduces pressure during market volatility. However, balance is key. Too much cash can limit long-term gains, so it works best within a structured investment strategy. Defensive sectors. Consumer staples and healthcare. Certain sectors remain steady even when the economy slows, and consumer staples and healthcare are prime examples. These industries provide essential goods and services that people rely on regardless of financial conditions. From food and household products to medical care, demand stays consistent. This stability often translates into reliable revenues and steady dividends. While these sectors may not deliver rapid growth, they provide resilience. In a recession, they act as a stabilizing force, helping offset volatility and creating a more balanced overall investment approach. Agriculture and farmland. Agriculture remains one of the most reliable sectors during economic downturns because demand for food never disappears. Regardless of market conditions, consumption continues, creating steady underlying value. Farmland in particular has historically shown gradual appreciation even when other assets decline. Investing doesn't require owning land directly, as funds and agricultural ETFs offer easier access. This sector also adds diversification since it doesn't move in sync with stocks, making it especially useful when traditional markets experience volatility or prolonged downturns. Foreign assets and currency diversification. Economic downturns don't impact every country equally, which creates an opportunity through global diversification. Holding foreign currencies or investing in international bonds spreads exposure across different economies. If one currency weakens, another may remain stable, helping balance overall risk. This approach reduces dependence on a single financial system. However, currency fluctuations and geopolitical events can introduce uncertainty. When managed carefully, international assets strengthen a portfolio by adding resilience and providing alternative sources of stability during periods of domestic economic stress. Cryptocurrency as a speculative hedge. Cryptocurrency stands apart from traditional assets, operating independently of central banks and financial institutions. Bitcoin, often compared to digital gold, is valued for its limited supply and decentralized structure. During uncertain times, it can attract attention as an alternative store of value. However, volatility remains a defining feature, with sharp price swings common. Because of this, crypto works best as a small, controlled allocation within a broader strategy. It offers diversification potential, but stability should come from more established asset classes. Managed futures and alternative strategies. Most traditional investments rely on markets rising, but managed futures introduce a different dynamic. These strategies use both long and short positions across assets like commodities, currencies, and indices, allowing them to perform in various market conditions. During recessions, when volatility increases, this flexibility becomes especially valuable. Instead of depending solely on recovery, these strategies can benefit from price movements in either direction. This adds balance to a portfolio, offering a way to navigate uncertainty without relying entirely on traditional growth assets. Skills and education. The overlooked asset. Not all valuable investments exist in financial markets. Skills and education often deliver the highest returns, especially during economic downturns. As industries evolve and job markets tighten, individuals with adaptable, in-demand abilities gain a significant advantage. Learning new technologies, strengthening business knowledge, or developing specialized expertise can open doors to new income streams. This type of investment increases long-term earning potential and resilience. Unlike stocks or real estate, it cannot lose value due to market volatility, making it one of the most reliable assets available. Small businesses and distressed opportunities. Recessions put pressure on businesses, but they also reveal opportunities. Some companies struggle due to debt or poor management, while others face temporary setbacks despite strong fundamentals. This creates openings for acquiring or investing in undervalued businesses. Distressed debt can also offer potential, where assets are purchased at a discount with expectations of recovery. However, this space requires careful analysis, patience, and experience. While the upside can be substantial, risks are equally significant, making disciplined decision-making essential for long-term success. If this breakdown brought clarity to how downturns actually work and what belongs on a real recession shopping list, make sure to like the video and subscribe to the channel for more strategies that simplify complex financial decisions. Share thoughts in the comments about which assets stand out the most and how a personal shopping list would look going into the next downturn.